Hi, I'm Doug Carroll for Insider's Guide to Finance, and in this video we're going to talk about bond markets, credit markets, and fixed income markets. Wait, isn't that three ways of saying exactly the same thing? Well, in truth, the way speakers toss those phrases around, they're often implying the same thing, but if one wanted to be technically precise, there are actually different shadings of meanings associated with each of those three phrases. So, as part of my ongoing mission to try to demystify some of the jargon related to the fixed income market, let's establish first principles. In other words, use very technically precise meanings for each of those three phrases, even though oftentimes when speakers on one of the financial news networks are batting those phrases around, they're actually implying the same thing. But that's often done simply to make the words more engaging rather than saying repetitively fixed income market, fixed income market, fixed income market. And by changing it up a little bit, they'll sound like a more knowledgeable, insightful speaker. So let's get into it. Now, in fact, there are four different phrases that are oftentimes used interchangeably with one another, even though they do mean slightly different things if one is interpreting them precisely. So the four phrases: bond markets, credit markets, fixed income markets, and debt securities markets. Now, in truth, two of those phrases would mostly be interpreted to imply precisely the same thing, at least by most people. So, debt securities markets and bond markets are effectively the same. Some might quibble about that a little bit, but the vast majority of market participants would interpret those two phrases as meaning exactly the same thing. So that leaves us with three different categories: credit markets, bond or debt securities markets, and fixed income markets. Now, as it turns out, one of those is so large it encompasses the entirety of one of the other categories and also subsumes about 98% plus of the third. So which of those three is the largest of all the categories? Well, that of course would be credit markets, because credit markets are the markets in which any sort of credit instrument is either originated or issued and subsequently traded, possibly. So what's a credit instrument? A credit instrument is simply a legal contract that requires one party, an obligor, to make payments to some other party, the holder of the contract, if you will. Now, of course, all bonds or debt securities are credit instruments, as they obligate the issuer or borrower to repay principal, and usually to pay some interest, some coupon rate of interest on top of the principal. So clearly, all debt securities are credit instruments. However, there are numerous categories of credit instruments that would not be considered bonds or debt securities. So it's a credit instrument? Well, some everyday examples many people would recognize would be mortgages or auto loans, more technically speaking, installment sales contracts. In either of those cases, a borrower has obtained funds to either buy property or possibly refinance it or to buy an auto. And as a result of that borrowing, they'll be obligated to make payments to the holder of the contract, possibly the mortgage originator, or maybe it's been sold to some other party. Or users of a credit card. Of course, when you pay for some good or service with a credit card, the credit card isn't actually money, but by offering up your credit card, in effect, you are borrowing money from the credit card issuer. So the provider of the service, the restaurateur, the theater owner, whoever, they receive payment, but the payment comes from the credit card issuer, and that creates a receivable, a credit card account receivable held by the credit card issuer, and that money has to be paid, probably over time with interest, by the credit card user. So if we look at a diagram that encapsulates the credit markets, and inside of that is completely subsumed the bond markets. So the shaded circle is the bond markets, because again, all bonds or debt securities are credit instruments. But note the larger unshaded circle shows many sorts of credit instruments that are not part of the bond market. Now, of course, at times, some of those credit instruments that are not initially debt securities get securitized. So in some cases, the holder of mortgage loans, initially the originator, will either package them and sell them off as investments, or they might sell them to a third party like one of the mortgage credit agencies in the United States, Fannie Mae or Freddie Mac. and they'll pool together a bunch of mortgage loans and sell those off to investors as mortgage-backed securities. That, in effect, has moved those mortgages from the credit markets generally into becoming part of the bond or fixed income markets. Or similarly, the holder of auto loans might package those in a trust and sell units of interest in the trust to investors as auto loan asset-backed securities. Or similarly, credit card issuers will take those credit card receivables, transfer them into a trust account, and sell claims against the trust account to investors, thus turning those credit card account receivables into credit card asset-backed securities. Now, what about the final category, fixed income markets? Well, look at the final diagram. Now we have an unshaded square, and inside of that a mostly shaded circle, although note how a little bit of the circle falls outside of the unshaded square. Well, that little sliver at the bottom there, that represents the portion of the fixed income market that actually isn't part of the credit or debt securities markets. And it turns out that category of instrument is what's known as preferred stocks. Now, preferred stocks from a legal or accounting perspective are considered equity securities. But they have many bond-like features. Just like most bonds pay fixed coupons, most preferred stocks have fixed anticipated dividend rates. Just like many bonds have credit ratings that assess the issuer's ability to pay interest and principal in a timely fashion, most preferred stock issues will have credit ratings that assess the issuer's ability to pay the anticipated coupon in full and in a timely fashion. And there's other features that preferred stocks have in common with bonds. Just like many bonds are callable or in some cases convertible, preferred stocks can also be callable and convertible. But the point is, since preferred stocks have so many bond-like features, they're properly thought of as fixed income securities and therefore would be treated as part of the fixed income portion of a portfolio if one was doing an asset allocation. So again, one has to develop the facility for listening to the speaker or reading into the mind of the author and trying to get a sense of whether they're using these phrases in a technically precise fashion or whether they're just trying to make their words more engaging by changing it up a little bit. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.